This is practice problem 3. We have another a more complex problem that we're going to solve now. This is a transportation company, ABC Transport Corporation, and they have purchased 5 trucks for 20,000 each. Depreciation rate is given to you 10% per annum using a written down value method, and I'll explain to you what this means. Then next year, at the beginning, one truck is sold for 15,000. In the middle of the following year, another truck has been purchased and has been sold, and then a new truck has been purchased. So there is a lot of sale and purchase of this asset, and the asset can be divided into multiple units. So 5 units of asset, 5 units of vehicles here, and then some units are being sold, some units are being added. You are required to prepare trucks account for the years ending on December 2001, 2 and 3. So we have to prepare the account for 3 years, and accounts are ending in December. So that is another thing which is different from the previous examples. The calendar year is the financial year, and we have to prepare accounts for 3 years, 2001, 2 and 3. So we will need to be clear about when the asset is being purchased, when it is being sold, what are the book values. So let us create that timeline to be sure of what is happening. So 2001 January is when things are beginning. So let me say 2001. This is the first year when the trucks are being purchased, and January 1. So you purchase trucks. So purchase of asset, I should say trucks rather, because we have the specific name of the asset and we always should write that name. So purchase of 5 trucks. So let me write 5 here, and 20,000 each. So the total amount comes out to be 100,000. So 100,000. All right. So next transaction is depreciation to be provided at 10% on January 1st, 2002, which means the first year is ending here. So let me put a slash here. This is the end of the first year, and we need to provide depreciation at this point in time. So December 31st in the first year, we have to charge depreciation. So depreciation at the rate 10%. Now is the question of what is written down value method. There are, let me contrast two methods of depreciation for you. One is written down value method, and the other one is straight line method. All right. So when you purchase an asset, so let's say the purchase of asset which costs you 100 in both the cases, the depreciation is going to be charged in the first case at the rate of 10% on this value, and you have 90 as the new book value, or which can be called written down value here. Now the new depreciation at the rate 10% is going to be charged on this written down value. Therefore, depreciation 10% is 9, and you have another written down value. Written down value. And all of this is happening in first period, second, and then again you can have depreciation at the rate 10%. So 8.1, 72.9 becomes your written down value. So this is called written down value method. You look at the latest book value in the accounting period, the not the latest, but the value of the asset at the beginning of the accounting period that you are considering. This is a written down value method. And as you go down, you would see that the value of asset will never become equal to zero. It will keep on reducing. It will become very close to zero if the life of asset is expected to be very long. So this is the first method. The second method is that you charge depreciation not on the written down value method but in a different way. And the way is to also estimate what is the life of the asset. Life of the asset here is, let's say, 10 years. Therefore, depreciation is going to be equal to the cost of the asset divided by the life of the asset. So 10 is the depreciation every year. So here you have written down value here, but now the depreciation is going to be 10. So written down value is 80, depreciation is again 10. So this is, different in the sense that the amount of depreciation is going to be different, and you ascertain the amount of depreciation at one go, and then there is no change. In such case, the amount, the value of the asset, the book value of the asset is going to become zero after the 10 years, after the life of the business. There's another variation which is possible here, which could be, let's say, at the end of the 10 years, the asset can be sold off at some price. So out of the 100 rupees, which is the cost of the asset, you will be able to recover 10 rupees at the end of the 10 years. Therefore, what should be the depreciation should be calculated not on 100 but on 90 only. Therefore, you divide by 10 and the depreciation is 9. So that is another slight variation if there is expected to be a scrap value. Scrap value simply means even if the asset is not functioning, you could sell it to the scrap dealers, by the kg and make this much amount. So these are the two methods. The written down value method is what is used in accounting. Income tax authorities recommend this method. Now, why do income tax authorities recommend this? Because the depreciation is an expense to be shown in the income statement, and you could manipulate your profits by using different depreciation methods. So for uniformity, for consistency, the income tax authorities recognize that when you have to calculate the profit to be paid, the tax to be paid on profit, so the calculation of profit is equal to incomes minus expenses, and expenses include depreciation, and tax is paid as a percentage of profit, so tax percentage. Therefore, you could show a higher amount of depreciation, which could be the case in the straight line method, and then show lower profits and hence pay lower taxes. So they say you only use written down value method. Also, the rate of depreciation varies from assets to assets, and there are accounting standards, there are rules which prescribe that this is the rate of depreciation on furniture, on fixture, on electronic equipment, and so on. Anyways, those things apart, I hope now you have understood the concept of written down value method of depreciation. So let's get back. The depreciation at the end of 2001 is going to be 10%, so 10,000, and the new book value, the written down value of 5 trucks is going to be 90,000. So this is the new book value or the written down value on 2002. 2002 January. I should have kept it cleaner, but maybe I could do this. Alright. On January 1st, 2002, one truck was sold for 15,000. Now, one truck has been sold on January, right on this date. We found the book value on this date, and now another truck is being sold. So sale of truck, one truck is being sold, and this is being sold for 15,000. So whenever a truck is being, an asset is being sold, there's going to be some profit or some loss. So what I'm going to do is create a new column to amount for one of the truck 1, let's say, which is being sold. So this truck was purchased for 20,000, and the depreciation at the rate 10% was provided. So 10% depreciation on this would have been 2,000. So this 10,000 includes the 2,000 on this one truck, and the value of this truck on January 1st, 2002 is 18,000. And this truck is being sold at 15,000. So this truck is being sold at 15,000. Therefore, there is clearly a loss of 3,000 which is happening. That because the book value of the asset is 18,000 and you're selling it at 15,000 only. Now, what happens is after this truck has been sold, the new balance has to be calculated. Out of the 5 trucks, you only have 4 trucks. So that adjustment will need to be made. And we will do that. Let's move forward. On July 1st, 2003, another truck is being purchased. So 2003 is next year. So let's close for this year on December 31st and then we can go to the next year. So December 31st, again the depreciation has to be charged. Depreciation has to be charged on only the 4 trucks that were there. Now if depreciation has to be charged on 4 trucks, now we have to figure out what is the amount. So I'm going to write balance. The balance here is 80,000 and you charge depreciation on this. The value is 72,000. And then depreciation on 4 truck is going to be depreciation on 72,000. So 10% depreciation is going to be 7,200, right? So this column is now discontinued because you're left with only 4 trucks. So you have only 4 trucks, 7,200. This is going to give you the, let me close it here. This gives you the value of the asset in 2003 January 1st, on the very first day or the last day of the previous year. Now the book value is going to be equal to how much? This comes out to be 64, 65, 72. That's correct. So 64,800 is the book value of the 4 trucks that you have with you. Now let us look at the next transaction. So 2003 here. So the next year begins here. On July 1st, 2003, another truck was sold for 18,000. July 1st. So I'm going to write July 1st. You sell another truck. Sale of truck. 1 truck is being sold. Now again I have to figure out the book value of this 1 truck which was purchased at the beginning of the whole thing for 20,000. So I'm going to go to another column and say truck 2. This is the second truck which is being sold. Let me say the sale case and the second sale case. Alright. So I purchased a truck for 20,000 here and then I charged a depreciation. The value was 18,000 and then for this year I charged depreciation as well, which was 10%. This is 1,800. Now this gives me 16,200 as the book value of the truck at the beginning of this year. The sale of the truck is happening in July, which means there is 6 months for which truck has been used. So there will be depreciation for 6 months for sure. So we have to charge depreciation here. So let me just create space for that. So instead of saying sale, we have to first say depreciation for 6 months. And this is only on the truck being sold on 1 unit. For 6 months, the depreciation is going to be 5%. So 10% is the rate. So let me first calculate 10%, which will be 1620, and then half of that is going to be 810. So this is the depreciation on this 1 truck which is being sold in the middle of the year. So we are charging 10% depreciation. 10% depreciation for 6 months, half the year. So on July 1st, you sell. So sale of truck. This truck is being sold at what price? The price at which it is being sold is 18,000. So you're selling it off at 18,000. Clearly there is a profit because the value of the truck was 16,200 minus 810. So there is a profit that will occur at the sale of this truck here. So this transaction is done. Let's look at the next transaction. A new truck is being bought on October 1st, 2003. So we are running in 2003 and now there will be October 1st. October 1st, new truck is being bought. So October, November, and December. 3 months are left in the same year, and a new truck is being purchased. So purchase of new truck, purchase of truck, one truck. Now I have to also calculate the balance here after the second sale. So let me just do that also. Now balance is three trucks. Two trucks have been sold. So I have 60,000 for which the three trucks must have been bought, and depreciation at 10% means 6,000, and you have 54,000 as the value of these three remaining trucks, and then you charge depreciation at 5,400 on these trucks, which gives you a book value of now 50, 49, 48, 49, yeah, 48 600. So this will be 49 and 54. That's correct. Now you are so this is the book value of the three trucks which you are left with. Now these two transactions are happening in the middle of the year. Nothing happens to this balance here. So a new truck is being purchased. Now I'm going to add a new truck. So let me say new truck. New truck 1 is being bought for how much? 30,000. 30,000 amount I'm going to write against this column here. 30,000 in October. Next up. That's it. Now you're required to close the accounts in the 3 years, 2001, 2, and 3, and say what is the balance at the end of the 3 years. Okay. Now, how does this new truck affect the whole, four trucks balances? Is as follows. We have to again get a balance. The balance is now four trucks at the end of the 2003. So on December 31st, you have to charge depreciation. So the question is how much depreciation to be charged? Depreciation to be charged at 10% on how many trucks? So you're going to charge depreciation on these. So you will have 4860 as the depreciation on the three trucks for the full year, and for the new truck that has been bought 30,000 you will charge depreciation at the rate 10%, however only for 3 months, because you have used it only for 3 months. So that means 30,000 multiplied by 10% multiplied by 3 by 12. So basically you are saying 3,000 divided by 4. So 750 is the depreciation on this number here. So 750. So total depreciation being charged during the 2003 financial year is equal to 4860 plus 750, which gives me 0 and 1 and 6 and 5. So this is the total depreciation being charged during this year. So the balance in the trucks account is going to be equal to 48,000 plus 30,000 minus this 56,000, and we could do it separately as well. So 48,600 minus 4860 gives me 4, and it gives me 7, and it gives me 3 and 3. So sorry, 4. So 43740, and here you have 29250. So these are the closing balances of three trucks, 4 trucks, and you can add these two and get the value of all the 4 trucks as well. So this is a bit complex. So I hope you get a hang of it. You can repeat the video, rewatch it, and see how things are happening. But this is the story. What I wanted to convey to you was assets can be purchased in the middle of the year. Assets can be sold, quarterly as well, on any day effectively. And accordingly, the depreciation has to be charged on those assets. Also, you have to figure out profit or loss happening on the sale of the asset as well. So using these working notes, we are going to now prepare the trucks account. So let's move forward. Oh, by the way, this should say trucks account. So we are preparing trucks account, debit side and credit side. We are going to start in 2001. So in 2001, you purchase 5 trucks. The transaction is going to be trucks account debit to cash or to bank. Let's assume bank. So trucks account debit to bank account on January 1st. To bank account 100,000. This is the value of the truck which have been bought. At the end of the year, you charge depreciation 10,000. So in 2001 only, on December 31st, I'm going to charge depreciation by depreciation, and I'm not writing the journal entry because I know depreciation debit to truck is how we do the transaction. So this is 10,000 as charged as depreciation. So the new book value is 90,000. On the same day, I'm going to close this account for this year and write by balance carried down, and the value is 90,000. 90,000, and I'm going to total this year. So 100,000 and close it in the conventional way. There you go. So now we have prepared trucks account for the first year, which is 2001, and we have a balance in the trucks account which is 90,000. Now we are going to carry this balance forward. We are going to bring this balance forward in the year 2002. On January 1st, we will write to balance brought down. So we are bringing this balance down 90,000. Again, this C/D, B/D, these are conventional terms. They mean carried down and brought down. So the new balance, the updated balance, the latest book value of the trucks is 90,000, and these are 5 trucks. Alright, the next transaction is on January 1st only. You are selling a truck for 15,000. So on January 1st, 2002, I'm going to write by bank because that's the transaction. Bank account debit to truck. That's how the sale of truck is recorded. And the money that you're getting is 15,000. 15,000. Yes. And there is a loss of 3,000 on this truck. So what is the journal entry when there is a loss? And I will write this journal entry here. When you sell the truck, the journal entry would be bank account debit. You get the money, 15,000. The truck goes out, so you will write to trucks account, but the value of the truck is 18,000. Debits have to be equal to credit, so there seems to be a deficit of 3,000. You could not recover the remaining 3,000. So this is loss on sale of trucks account. So in the trucks account, I'll go to credit side and I'm going to write by bank and by loss on sale. 3,000 is going to be the loss on sale account. This is on January 1st as well, on the same date when the sale of truck is being done. So one truck has been written off now. So we are done here, and let's go to December 31st. Depreciation to be charged on 4 trucks is 7,200. So December 31st, you have by depreciation. Depreciation is being charged on the remaining trucks, remaining 4 trucks. This is equal to 7,200 here. So the value of the trucks now that you have is 64,800. So 64,800 should come out to be the balance in the account. So this should be by balance carried down. So when you do these numbers, 90,000 and you deduct from 90,000 the total of the sum of this, then you reach at 64,800. Since I already had the working the calculations in my working table, I just picked this number from there. So this is 18,000, 25,200, and if you do 25, add 25,200 to 64,800, you get 90,000. So basically, this is a balancing figure, is what I'm saying. All right. The next year starts, which is 2003. On January 1st, we bring the balance forward. So, two balance brought down. The balance is 64,800. Then what happens is on July, you have sale of another truck. So I'm going to go to the account, write 2003 July 1st. So 6 months have gone by up till June, and on the very next day, a sale of asset is being done. So I'm going to write by bank account. This is sale of asset. So the sale of asset is for 18,000. So 18,000 rupees received, and on the asset which is being sold, depreciation for 6 months is being charged, which is 810. So I'm going to write by depreciation. This is depreciation on one truck which is being sold on July 1st. So only 6 months of depreciation, 810. And the book value of the this one truck was 16,200, and the depreciation was 810 for the 6 month period. Therefore, the value of the truck as on July 1st is equal to 16,200 minus 810. So this gives me 15,390. This was the value of the truck. You sold it for 18,000. So the profit you're making money. You are selling the truck at a higher price than its actual price. Therefore, you are making a profit equal to 18,000 minus 15,390. So this gives me 400 and 600, and then I have 2. Yeah, that's right. So this is the amount of profit that you make. Let me just double check this. This is 400, 600, uh, yeah, 17 and 18,000. That's correct. So 2610 is the profit that you make on the sale of this truck. Now we have to write a journal entry for this because this is a bit complex and need to be able to explain this to you. So I'm going to go to this slide and write the journal entry. When you sell the asset, the cash comes into your bank account. So bank account debit 18,000, and there is depreciation on this asset for the 6 month. Depreciation account debit 810. The truck goes out, so to trucks account, the asset account, the value of the truck was 16,200 here. So the value of the truck at the beginning of 2003 was 16,200. It went down by 810, and then you made 18,000 at the top of it. Therefore, it leads us to a profit of 2610. So that profit will be 2610 written here, because all incomes and gains, all profits are going to be credited. So I'm going to write to profit on sale. And this also introduces you to a new type of transaction where there is profit on sale rather than a loss on sale. If there was a loss on sale, we would have written it in the debit side. However, here you have a profit on sale. And just to verify, all debits must have an equal credit. The total of the debit side is 18,810, and the total here is 810, 18,810. All debits must have an equal credit. Since this is the journal entry, the question is, how are we going to post this in the ledger account? So we are preparing trucks account. We are going to go to the credit side in the trucks account and post both of these first of all. So 18,000 and 810 have already been posted on the credit side. Now there is a new treatment for the profit. If there was a loss, we have to show it, on the credit side only. But this, there is a profit, there's an additional money that is being made, so suddenly this side is being inflated, and we have to inform the viewer of the financial statement that there has been a profit. We do that by way of showing the profit on the opposite side. So to profit on sale. Just like we had loss on sale on the credit side, we are putting profit on the opposite side. So intuitively, that is the way to do it. However, if you look at the journal entry, you are preparing trucks account and you are, posting both the entries on the credit side. However, till now we've not done a profit on sale entry being done on the opposite side. So this is kind of an exception or a new kind of treatment that you have to do when you have sale on the profit on the sale of an asset. So 2610 is the profit on the sale of the asset, and you write it on the opposite side in order to balance these two, account for this additional money that you're making. So what is happening really is the value of the truck is 16,000 lower than 18,000. So there is some additional money being made here. So on the opposite side, you have to show that the value of the asset was not high, but the value has increased because we have sold it at a higher price, and a profit has been received in return. Okay, let's move on to the next entry, which is going to be now purchase of this truck on October 1st for 30,000. Same year, October 1st, I am going to write to bank account because that's the transaction for purchase 30,000. And that's it. Finally, you have depreciation which is being charged. So December 31st, we are going to charge depreciation. Depreciation is going to be charged on both the new truck being purchased and the previous previous group of trucks that you have, which is equal to 3. And we've done those calculations. So the depreciation is 4870 plus 750. These are the two amounts of depreciation. So total depreciation is 5610. So 5610 is the depreciation. So at this point in time, December 31st, we are going to figure out the balance in the trucks account. Now the balance in the trucks account according to this is 4370 plus this amount, but we can also do the calculations here. So you just so let me use this space. So all you have to do is sum these up. 14,800 plus 2610 plus 30,000. So the total is 9741 and you have to sum this up in order to take it out from the total on the other side. So you have 18,000 plus 810 plus 5610, which gives you 24,420. Now 24,420 needs to be taken out of 97,410, which gives you a balance of 72,990. Now this is the balance left in the trucks account. So by balance carried down on December 31st. The total is 97,410 and you close this account. Now if you want to verify this, you could go to the previous slide here and you can sum these two numbers up. So when you sum up 43,740 and 29,250, the amount that you get is 72,990. So let me just write that here as well. So this is the remaining value of the 4 trucks. So these are 3 trucks, this is the 4th truck. This also sums up to 72,990, right? So accordingly, we have 72,990, which can be figured out using this process as well. So that is how the asset account, any asset account is going to be prepared. There will be transaction of purchase and sale. You could of course take it further to 2004 January 1st and say to balance brought down, and the new balance is 72,990, and you have 4 trucks in the account, and it can continue. It is going to continue because business is expected to continue for a long period of time. Trucks are going to be purchased, trucks are going to be sold as well. There will be profits, there will be losses, there will be depreciation. So that's a detailed, deep dive into preparing a trucks account, preparing an assets account. So that's it for this practice problem. I hope this clarified a number of new concepts that we've not discussed earlier. I'll see you in the next video.